Working capital finance. Working capital finance is designed to beef up the available funding of a business. Different businesses make use of working capital finance for a variety of purposes, such as launching a business, expanding in a new market, or introducing a new product or service. However, the general idea is that working capital finance should give you, as a business, the breathing space to use cash within the short to medium term. You can access working capital in several ways, with overdraft, invoice financing, bank guarantee, trade finance, and tax bill as the most popular ways. Overdraft. Overdraft is the most popular and most suitable mode to secure immediate working capital finance among both small and large firms. It is an offering of big banks which provide borrowers with a particular amount that can cover for certain business payments. However, the borrower has to make sure not to go beyond the sanctionable credit limit, as this could entail higher interest rate in the payment of the loan. Nonetheless, an overdraft is considered the most cost-effective among all working capital finance. The interest charged is based on how much money was used, thereby encouraging the borrower to return the money as soon as possible to save on interest cost. The downside, however, is that overdrafts usually have low credit limits, which can restrict the borrower from employing growth projects. Invoice financing. Invoice financing is the most common working capital finance for a business that offers its customers credit terms. It allows the enterprise to sell its invoices to a finance firm, which, in turn, will provide immediate payment. Factoring, the simplest form of invoice financing, includes credit control, thereby making it friendly for small businesses with lower value invoices. However, invoice financing can only do so much. The borrowable amount is limited in accordance to the value owed to the borrower through customer invoices, so this may not be the best option if your business pursuit requires higher capital for its long-term growth plans. Further, to qualify for invoice financing, you will most likely need a high credit score and be free from financial burdens. Bank guarantee. Bank guarantee is a non-fund-based working capital finance that various lending institutions offer. Under this scheme, the lender will make sure the liabilities of the beneficiary will be met, including unpaid debts. Say, your business is purchasing large volumes of raw materials from a particular seller. If this is the case, you can make use of a bank guarantee as an assurance your procurements will be paid. The holder terminates a bank guarantee only in case of non-performance by the other party. In return, the lending institution can charge some commission and may also ask for security. There are several types of bank guarantee, but banks often use a direct guarantee, issued directly to the beneficiary who operates either in the foreign or local setting. Trade finance. Lenders can provide you with trade finance if your business is creditworthy, as reflected in its earnings, liquidity space, and payment records. Like any other sources of working capital, it comes with a cost after the free credit period. Ideally, for exporters and importers, trade finance can help reduce risks on global trade by reconciling the capital needs of both traders. One of the most common forms of trade finance is a line of credit, which can be released by big banks to fund exporters and importers. Another method is a letter of credit, wherein the buyer's bank secures payment to the seller for the goods shipped. Further, there is the export credit supplied to exporters, as well as insurance deals that can be used to protect the trader from non-payment by the buyer. Tax bill. Times can be difficult for enterprises during January and April, as business bills start to pile up the mailbox and tax officers run after firms who owe the government. The good thing is there are value-added tax loan facilities that are ideal for small firms that find itself owing on their tax bills. United Kingdom-based Merchant Money, for one, offers a short-term tax and VAT funding of up to £150,000, and this lender can make approvals within 24 hours. Under this scheme, Merchant Money pays the lender's tax with the option to spread the cost of paying their tax bills. Further, available terms range from 1 month to 12 months, and the funds are paid directly to Her Majesty's Revenue and Customs. With this method, the costs are well spread, giving your firm some fiscal space to work on other aspects in its operations. With a handful of available options, you can now proceed with your next project by securing working capital finance. It's only a matter of picking out the best financing scheme that can work around your current situation. So it's worth assessing how much you would need and how much you can afford to repay to avoid falling for a borrowing scheme that could cause pitfalls to your business and your credit profile. Provided a competitive and flexible finance package. All in all, would certainly do it this way again.